Welcome to Exploring Conventional Loans, Requirements and Benefits. If you're considering buying a home, understanding your mortgage options is essential for making informed financial decisions. In this video, we'll dive into conventional loans, the most popular mortgage type in the U.S., covering what they are, their benefits, and the requirements you need to meet to qualify. Whether you're a first-time homebuyer or looking to invest in a property, this guide will help you decide if a conventional loan aligns with your goals. Let's get started. What are conventional loans? A conventional loan is a mortgage offered by private lenders, such as banks, credit unions, or mortgage companies, and is not backed by a government agency like the FHA, VA, or USDA. Instead, these loans often follow guidelines set by Fannie Mae and Freddie Mac, two government-sponsored enterprises that purchase most conventional loans to keep the mortgage market stable. In 2023, conventional loans accounted for 67.6% of home sales, making them a top choice for borrowers across the country. Unlike government-backed loans, conventional loans rely on the borrower's financial profile, which means lenders set stricter requirements, but also offer more flexibility in terms of property types and loan terms. You can use a conventional loan to buy a primary home, a second home, or even an investment property, which makes them highly versatile. Let's explore why so many borrowers choose conventional loans by looking at their key benefits. Benefits of conventional loans. Conventional loans come with several advantages that make them appealing for a wide range of borrowers. Here are the primary benefits you should know about. Competitive interest rates. If you have a strong credit score, conventional loans often come with lower interest rates compared to government-backed loans, like FHA loans. A higher credit score, typically 720 or above, can unlock the best rates, potentially saving you thousands of dollars over the life of the loan. For example, on a $300,000 loan with a 30-year term, a 1% lower interest rate could reduce your monthly payment by about $200 and save you over $70,000 in interest. Lenders like Duane Buziak at Coast to Coast Mortgage work to secure competitive rates by comparing offers from multiple lenders, ensuring you get a deal that fits your budget. Flexible loan terms. Conventional loans offer a range of terms to suit different financial situations. You can choose a fixed-rate mortgage with terms like 15 or 30 years, or an adjustable-rate mortgage arm, such as a 5-to-1 arm, where the rate is fixed for 5 years before adjusting. A 15-year fixed-rate loan typically has higher monthly payments but lower total interest costs, while a 30-year loan offers lower monthly payments, freeing up cash for other expenses. This flexibility allows you to tailor the loan to your financial goals, whether you prioritize paying off your mortgage quickly or keeping monthly payments affordable. Low down payment options. One common myth is that conventional loans require a 20% down payment. In reality, you can qualify with as little as 3% down if you're a first-time homebuyer or 5% for other borrowers. For a $300,000 home, that's just $9,000 or $15,000 down, making homeownership more accessible. Programs like Fannie Mae's Home Ready or Freddie Mac's Home Possible offer 3% down options with reduced mortgage insurance costs for eligible borrowers, such as those with lower incomes or buying in designated areas. No mortgage insurance with 20% down. If you put down less than 20%, you'll need private mortgage insurance, PMI, to protect the lender in case of default. PMI typically costs 0.5% to 1% of the loan amount annually, added to your monthly payment. However, unlike FHA loans, which often require mortgage insurance for the entire loan term if you put down less than 10%, conventional loans allow you to cancel PMI once you reach 20% equity in your home. If you can afford a 20% down payment upfront, you can avoid PMI entirely, reducing your monthly costs significantly. Versatile property types. Conventional loans can be used to purchase a variety of properties, including primary residences, second homes, and investment properties. This versatility is a major advantage over government-backed loans, which often have restrictions. For example, VA loans are limited to primary residences for eligible veterans, and USDA loans are restricted to rural areas. With a conventional loan, you can buy a condo, a single-family home, or even a multi-unit property, making it a great option if you're looking to diversify your real estate investments. These benefits, competitive rates, flexible terms, low down payments, cancelable PMI, and property versatility, make conventional loans a powerful tool for achieving homeownership. However, qualifying for one requires meeting specific financial criteria. Let's break down those requirements next. Requirements for conventional loans. Conventional loans have stricter requirements than government-backed loans because they're not insured by the federal government. Lenders rely on your financial stability to approve your application. Here's what you need to qualify in 2025, based on guidelines from Fannie Mae, Freddie Mac, and industry standards. Minimum credit score. To qualify for a conventional loan, you'll need a minimum credit score of 620, which is considered fair credit. However, to secure the best interest rates and lower PMI costs, a score of 720 or higher is ideal. Lenders typically pull your credit reports from all three major bureaus, Experian, Equifax, and TransUnion, and use the middle score to determine your eligibility. If your score is below 620, you may need to improve it by paying down debt, making on-time payments, or correcting errors on your credit report. Professionals like Duane Buziak can offer guidance on boosting your score without impacting it through a soft credit pull. Down payment. The minimum down payment for a conventional loan is 3% for first-time homebuyers or 5% for other borrowers, depending on the lender. For a $400,000 home, that's $12,000 or $20,000 down. If you have a lower credit score or a high debt-to-income ratio, some lenders may require a larger down payment, such as 10%. For jumbo loans, those exceeding the 2025 conforming loan limit of $806,500, you may need 10% to 20% down, depending on the lender's requirements. Debt-to-income DTI ratio. Your debt-to-income ratio, or DTI, measures how much of your monthly income goes toward debt payments, including your future mortgage. Lenders prefer a DTI below 43%, though some may allow up to 45% or even 50% if you have strong credit or significant cash reserves. For example, if you earn $7,000 a month and have $2,000 in monthly debt payments, including your mortgage, your DTI is about 28.6%, which is well within the acceptable range. To lower your DTI, consider paying off smaller debts like credit card balances or auto loans before applying. Stable income and employment. Lenders typically require at least 2 years of stable income and employment history to ensure you can make consistent mortgage payments. If you're employed, you'll need to provide pay stubs, W-2s, and employer verification. If you're self-employed, expect to submit 2 years of personal and business tax returns. Programs like Home Ready or Home Possible may offer flexibility for self-employed borrowers with less than 2 years of history, but you'll still need at least 1 year of tax returns to qualify. Loan limits. Conventional loans are classified as conforming or jumbo based on their size. Conforming loans must fall within the 2025 limit of $806,500 for a single-family home in most areas, or up to $1,209,750 in high-cost regions like Alaska, Hawaii, or parts of California. If you need a loan above these limits, you'll require a jumbo loan, which comes with stricter requirements, such as a 700-plus credit score, 10% to 20% down, and significant cash reserves. Cash reserves. Some lenders require cash reserves, savings to cover several months of mortgage payments, to ensure you can handle financial emergencies. This is particularly common for borrowers with lower credit scores, higher DTIs, or those buying multi-unit properties. Typically, you'll need 2 to 6 months' worth of reserves, though jumbo loans may require 12 to 24 months. For example, if your monthly mortgage payment is $2,000, you might need $4,000 to $12,000 in savings beyond your down payment and closing costs. Meeting these requirements can feel challenging, but with preparation and the right guidance, it's entirely achievable. Mortgage professionals like Duane Buziak at Coast to Coast Mortgage can help streamline the process, offering tailored advice to improve your eligibility and secure favorable terms. How conventional loans compare to other options. To determine if a conventional loan is right for you, it's helpful to compare it to other mortgage types. Here's a quick overview. FHA loans, backed by the Federal Housing Administration, allow credit scores as low as 580 with 3.5% down, or 500 with 10% down. However, they require mortgage insurance premiums for the life of the loan if you put down less than 10%, which can increase costs. VA loans, available to eligible veterans and active duty military, offer no down payment and no PMI but are limited to primary residences. USDA loans, designed for rural areas, also have no down payment but come with income and geographic restrictions. Conventional loans strike a balance between accessibility and cost savings. With a minimum 3% to 5% down payment and a 620 credit score, they're within reach for many borrowers. And the ability to cancel PMI with 20% equity can save you money over time. If you're unsure which loan type suits your needs, a mortgage professional can help you compare options based on your financial profile. Tips for qualifying for a conventional loan. If you're ready to apply for a conventional loan, here are 6 practical tips to improve your chances of approval. Check your credit. Review your credit reports from Experian, Equifax, and TransUnion for free at annualcreditreport.com. Dispute any errors and pay down high credit card balances to boost your score. Save for a down payment. Aim for at least 3% to 5% down or 20% to avoid PMI. Start saving early and explore down payment assistance programs if needed. Lower your DTI. Pay off smaller debts, like credit cards or personal loans, to reduce your debt-to-income ratio and improve your loan eligibility. Gather documentation. Prepare pay stubs, tax returns, bank statements, and employment records to streamline the application process. Being organized can speed up approval. Compare lenders. Shop around for the best rates and terms. Working with a mortgage broker like Duane Buziak can save time, as they compare offers from multiple lenders on your behalf. Complete homebuyer education. For first-time buyers, programs like Fannie Mae's HomeView or Freddie Mac's CreditSmart offer free online courses that may fulfill lender requirements for low down payment loans. By following these steps, you can position yourself as a strong candidate for a conventional loan and move closer to homeownership. Why work with a mortgage professional? Navigating the mortgage process can be complex, especially with the specific requirements of conventional loans. A knowledgeable mortgage professional can make a significant difference by guiding you through the application, helping you understand your options, and securing competitive rates. Duane Buziak at Coast to Coast Mortgage, for example, offers expertise in conventional loans, which make up nearly 40% of his portfolio. With a focus on personalized service, he helps clients find loans with flexible terms that align with their financial goals. Is a conventional loan right for you? Conventional loans are an excellent choice for borrowers with solid credit, stable income, and the ability to meet down payment and DTI requirements. They offer competitive rates, flexible terms, and the potential to save on mortgage insurance, making them ideal for purchasing a primary home, second home, or investment property. However, if your credit score is below 620 or you have limited savings, you may need to explore government-backed options or work on improving your financial profile. To determine if a conventional loan fits your needs, consider your credit score, income stability, down payment savings, and the type of property you want to buy. Consulting with a mortgage professional can provide clarity and help you explore all available options. Conclusion. Conventional loans are a cornerstone of the mortgage market, offering a balance of accessibility and cost savings for borrowers. With low down payment options, cancelable PMI, and the ability to finance various property types, they're a versatile choice for achieving your homeownership dreams. By meeting the requirements, a 620-plus credit score, 3% to 5% down, a DTI below 43%, and stable income, you can take advantage of competitive rates and flexible terms. If you're ready to explore conventional loans, reach out to a trusted mortgage professional like Duane Buziak at Coast to Coast Mortgage. Visit www.duanebuziakmortgagebroker.com or call 877-220-5533 to get started. Your dream home is within reach. Take the first step today. Thank you for watching Exploring Conventional Loans, Requirements and Benefits. We hope this guide has empowered you with the knowledge to make informed mortgage decisions. Stay tuned for more home buying tips and insights.